Well, good afternoon, everyone. My name is Art Alvarez with Mortgage Works, where we have the answers and they're on the house. Welcome to this week's Mortgage Minute. As you can tell by the background where I'm at now, I'm not, doing this show from our office. I'm actually in Indian Wells. I'm attending the California Association of Realtors winter meetings, which have been going on since Tuesday through tomorrow. So we're broadcasting our show today a little bit more remotely. So hopefully we don't run into any technical difficulties. But again, welcome to this week's Mortgage Minute. The weather's great here, nice, bright, sunny afternoon, mid to high 70s. So with that, as you know, what I like to do is start you off with an update on the mortgage market, mortgage rates, and the bond market. So Jeff's going to pull up our rate grid that you can go to our website to check it out. This will give you an indication of where mortgage rates are. And as you probably may have seen in the news, we're kind of backed away from that 7% threshold on conforming mortgages. From our rate grid, you can see we're now back to the mid sixes, 6.5% for conforming 30-year fixed. The buy downs, both 3-2-1s and 2-1s, also have a note rate at 6.5%. FHA is just now getting back to breaking through that 6% barrier a little bit. VA is almost there, and jumbos, of course, are in the low sixes. And don't forget those equity loans. In particular, I might point out, unlike before, fixed rate seconds are getting extremely well priced. Those rates can be very, very low, as Jeff's pointing out. If you can imagine a fixed rate second mortgage at 6.9%, that's almost as good as a first mortgage, which is usually not the case. So for any of those homeowners out there who have a lot of equity and you're looking to tap into that equity, be happy to talk to you about your equity loan options. So with that, let's take a look at the bond market on the bond chart. Remember, this is a bond chart for the last 5 days, going back to last Friday. And this is the kind of trend we like to see. It was up there basically touching 4.6% earlier this week. We're now down 4.43 as of when this picture was taken earlier today. And so that's a good trend. And of course, you're probably wondering, well, what's going on there? Why is this happening? Well, there's a few things going on in terms of economic data points. Earlier this week, we had the ISM, both manufacturing and services indices come out. Both were a little bit softer than forecast. So of course, when that happens, when manufacturing's slowing a bit, services slowing a bit, that's usually going to be good for bonds. Same with JOLTS. Remember, JOLTS is a job opening labor turnover survey. Job openings are down to 7.6 million. Not too long ago, in 2022, it was over 12 million. So this $7.6 million jobs is an indication that we're having a little bit of a cooling down in the labor market, but nothing to get too concerned about. The real issue in terms of bond yields today or this week, and the big drop occurred yesterday when we got down to those low 4.4 range, was the U.S. announced that they will not be increasing the pace of debt issuance. What does that mean? What that means is the U.S. government basically did a press release where they announced that they were not going to be increasing the number of treasury bond sales, which of course the reason they would be issuing more treasury bonds for sale is to help fund the federal government. So the U.S. announced that they're not going to be increasing the pace of those sales. That was considered good news for bonds because when you do have more debt issuance, more treasury bonds hitting the market for sale, well, that's an increase in supply. Basic Econ 101 says you increase the supply of those bonds for sale to get them sold, the yields have to go up. So when this was announced, it was very good news to the bond market. And so that's why you saw that 10-year yield drop down to the low 4.4 range. Now it's ticked up a couple of ticks since then yesterday, but still holding pretty steady there at the 4.43 that we mentioned earlier. And of course, tomorrow is the jobs report. That's going to be the unemployment rate, the number of new jobs added to the economy. That's always a market mover. So pay attention to that because the jobs report could have an effect on our bond yields depending on what the numbers come out. If we have a little bit of softness without too much, I think that could be good for bonds, and who knows, maybe we could break that 4.4% barrier on the 10-year. So with that, I'm going to go ahead and bring Jeff back in so we can have our discussion this week about all things in the mortgage market. Hi, Jeff.
Hi, Art. Hey, thanks for diving out or dipping out of the conference. I know you're very much involved in that.
Sure.
Any breaking news from that you need to share with us, that things that you see from the inside?
Well, being that this is a conference for realtors, it's the California Association of Realtors. A lot of the news in terms of what's going on in real estate, obviously a good portion of it has been addressing the fire disasters in LA, and things like forbearance, mortgage forbearance. There's a proposal where the California Association of Realtors, is supporting increasing the period of mortgage forbearance from 90 days that was initially forecast to going out a full year. And so CAR is getting behind that to support it. And of course, with these kind of conferences, there's a lot of people here, a lot of brain power, a lot of folks thinking about the issue. And you get into some pretty good discussions about, unintended consequences. For example, in one session yesterday, talking about this increase in forbearance, one member brought up the issue of, well, what about private party lenders, i.e. somebody who maybe sold their home that was free and clear, and they agreed to carry back the mortgage. And his point was, a lot of cases that would be older homeowners, older sellers, and they're carrying back that mortgage for whoever bought their home. And that's their primary source of income, because they're probably retired, have limited income, and part of what drove them to agree to sell or carry was to generate that income stream, which is very helpful in your golden years, right? So the unintended consequence is if this mortgage forbearance is put in place out for a year, that can greatly harm those private lenders who had carried back, and it's going to be a disruption to their primary source of income to live on. So it's an interesting issue, and there was a lot of debate back and forth about that. And of course, it got into a whole discussion about how do you define a private lender, because some private lenders are not mom and pops. There are major companies out there who are private money lenders. I actually do business with one in San Francisco. They're a major lender. They're not a mom and pop. They have many people work there. Now they have investors who fund a lot of their loans that they originate or that they arrange, who individually, those may be private individuals. But I would say in a lot of cases, those are not people who are, 80-year-old mom and pops who are, that's their primary source of income. In a lot of cases, I think those are more, wealthy individuals who are simply diversifying their investments of the cash that they have to, gain good yields. So there's a lot of issues there to kind of sort out. The other big thing, of course, the big talk is insurance when it comes to buying and selling homes, and the very great difficulty that home buyers and homeowners are having with getting insurance coverage, the cost of insurance coverage. And there was actually a proposal made that insurance companies need to give a homeowner 30-day advance notice before they use drone technology to look at their home, specifically their roof, for example, because what's happening is people are literally getting notified by their insurance carrier, by the way, we had a drone look at the top of your house, your roof, and we've decided based on just visual inspection via a drone, your roof is bad and we're going to cancel you. And there's been some stories. One of the gentlemen who brought this up in the meeting yesterday was a homeowner got this kind of a notification, but he had literally replaced his roof less than 5 years ago. And so his roof was fine. But just because of the drone, which he was not made aware of in advance, he gets essentially a letter in the mail saying, you're canceled. So that's a little bit of an abuse, perceived abuse by the insurance companies that is being addressed here in this conference.
That's pretty unusual. I'm curious about the idea of using a drone, that technology in the insurance. It is becoming such a challenge we've heard it in our groups. How much is this harming the transactions and the sales when it comes to real estate, that people just kind of throw their hands up and say, "Gee, I can't buy your house because I can't get insurance"?
Well, the general consensus seems to be there hasn't been a tremendous number of transactions that have not been able to go to fruition, not be able to be completed. Hasn't been a huge percentage of that, at least not yet. We'll see what happens with insurance rates and so forth with this latest disaster. But where the struggle has been is, I would say, delay in closing transactions because the home buyer didn't start the work of shopping for insurance early enough in the transaction. Not too long ago, it was an afterthought. You're 5 days from closing. Oh, got to get insurance coverage. Call somebody. You get the binder in a day or two. We're urging people now, as soon as you open escrow, you got to start shopping for insurance and get something you can afford as soon as possible. The other issue being that the premiums that home buyers are encountering are substantially higher, that haven't jeopardized too many transactions, at least not yet. We'll see if insurance premiums jump even more with these latest disasters, but it's causing some certainly frustration with home buyers where they thought maybe they could get maybe even a condo where they thought they could get $1,000 a year or $1,200, and it's $2,000 or $2,200 for a condo. Wow. I actually recently closed a manufactured home on land. It's real estate. And the buyers shopped around. They had trouble finding an insurance provider. They finally got one, and they bought this manufactured home for $390,000. Their annual insurance premium was $2,400 a year.
Holy smokes!
That is substantially above what it used to be just a couple of years ago.
Wow. Yeah, I'm just curious, and then we'll move on, is how much of this is just affecting the state of California, or are we seeing this across the U.S.?
Anecdotal evidence is it's affecting the whole country, because you have to consider, there are, and we all know the names, there's the major carriers that most of us are aware of, State Farm and Allstate and so forth, Farmers. These companies, though they're nationwide companies, they have loss exposure maybe in certain states, Florida because of hurricanes, California because of wildfires or landslides or flooding perhaps. And so that can affect the company overall, so that when you have these certain hotspots, maybe a bad choice of words in terms of what happened in LA recently, but when you have these disasters in certain locations, it can still affect the company overall, so that it's going to have a trickle down effect, if you will, to homeowners in other states where maybe there isn't a major issue with any disasters in terms of what their premiums are going to be, simply because those companies still have to make a profit, and they've got to make up for it somehow. And a couple of bad areas causes premiums to go up for everyone.
What do you think if you're discussing it at all? I just recently listened to a fairly long program on the shift of insurance, homeowners insurance, and that we ought to be building homes that are less likely to suffer from disaster. Now, in this particular conversation, because again, it's on everyone's mind, is the LA fires, to make them so that they are fire resistant. And was any discussion on that going with your group, or is that outside?
No, actually, it's funny you mentioned that, and I'm going through my notes, pardon me for this, but there was a discussion about looking at there's a concept of safer from wildfires. So there's a proposal to shorten the period of time for review of what kind of building materials, et cetera, should become construction industry standards for improving the fire resistant ability of newly built homes. So that was addressed and discussed here at this conference. And I think it makes sense, obviously, that with something as severe as what we just saw in LA, there needs to be a little bit more focus of looking at reviewing on a more regular, more frequent basis what needs to be done to, building standards to create more of this safer from wildfires standard. So yeah, that was discussed here.
Yeah, good. Well, let's get into today's topic, because there's a couple of things that are on the mind of our viewers, and one was VA loans, and here it says totally underutilized, and then the next one, and we'll start out here, is the perfect storm aligning for home buyers, and this was something that after, especially this past week in a meeting you and I were both in, and the real estate agent, the first time I'd heard her say this now in 2 years, where she said, I need buyers. I have more inventory than I need buyers. And so I just think, all I can think of, again, you've said it before, Econ 101, supply and demand. So I pulled up a couple things, and I'll just have you kind of walk us through it, because this is your expertise. This first one is just a little chart that I pulled up about existing home sales, median home price, and inventory. And I see that, change November 2024 from December 2023, what kind of things we're seeing on there. Tell us about this.
Well, the thing about the existing home sale numbers, I mean, when you look at this at first glance, you say, well, those are pretty good numbers, right? 9% increase from 2023. 2% increase from just the previous month. December was 4.24 million. So you look at that and you say, well, that's pretty positive. That's encouraging news. But one of the things that I always talk about as it relates to statistics is when you see these percentage numbers and this percentage improvement, you always have to ask yourself, improvement from what? From what level? So yes, these are certainly encouraging improvement, encouraging increase in percentages in terms of number of sales, number of transactions. But a reminder that 4.24 million sales of existing homes is still literally only 2/3 of what it was before the pandemic. A more normal number would have been, or should be, over 6 million.
Wow.
6.5 million. So this is like coming back from the bottom. And so, yes, those percentage increases are certainly positive, but I would argue, and I'm not trying to be negative too much, but the understory here is we still have a long way to go. We need to see that number get to 5 million and 6 million in a month, not 4. And it's encouraging that we're over 4, because it was only just a few months ago that number was in the high 3s, which was really a depressing number. Now, the other thing that I find interesting with this chart is median home price. Existing home sales are way down, and yet median prices are still going up 6% from 2023. So again, this notion that the affordability challenge, the affordability crunch, because prices are too high, rates are too high, should mean home prices should come down. They're not. We talked about it last week. The Case-Shiller index showed 4.3%, I think, year over year in their 20-city index. This is another example of, despite these prospective buyers standing on the sidelines waiting for home prices to fall, it's not happening. And then, of course, the other thing is housing inventory. It's coming back somewhat. And again, look at December 23, up 16% since December 23. And yet it dropped from November by 13%. So you got a kind of a hit and miss there. We've gone from the pandemic days of 1 to 1.5 month supplies to, in most markets, 3 to 4 month supply. But that increase is good, and it's providing some opportunity for home buyers. One of the numbers that came out for January, which was unusual, was the very high percentage of listed homes that had price reductions, like a third of it. That's unusual for January. January is usually a pretty strong month for home sales, and you don't usually see that percentage of price reductions this early in the year. So that it's a little bit of a mixed message. On the one hand, you go, okay, why are they having to lower the price when there's shortage of inventory? And I think what's happening there is, yes, the mortgage rates are affecting that a little bit, but again, that reduction in price isn't substantial. What I'm seeing is price reductions are maybe 2 to 3% from original list price. That does give buyers a little bit more opportunity for some leverage. And what I'm hearing from agents, I'm hearing it here at this conference, I'm hearing it in our local market in Palm Springs, Coachella Valley. Traffic at open houses is up. There's more buyers out there looking around. However, that hasn't yet translated into a significant increase in offers and accepted offers and opening escrows. It's kind of starting to go that way, but it's not there yet. A lot of these buyers are just poking around, but they're not quite signing on the dotted line, at least not yet.
I'm curious, Art, because again, you've got your thumb on the pulse of those agents there. With the litigation that was settled and how we have to now go about buying a home and signing up an agent and all that type of stuff, have they said that had any effect on the buyers kind of staying on the sidelines, or maybe they're not sure, oh, geez, I've got to come up with $30,000 to buy a house, or, these misunderstandings in their head?
I think when that change occurred, the NAR lawsuit and the buyer's agent having to negotiate directly with their buyer and execute what's called a buyer's broker agreement, where the buyer agent commission has to be agreed upon by the buyer. I think initially for a brief period, there was some confusion. I think that caused some buyers to hesitate. What I'm seeing play out though is, and I kind of expected this, I think we talked about it a few months ago in our program, the way it's settling out is I think agents are doing a pretty good job of explaining to their buyer when they're confronting them with, they've got to sign this agreement that says, you, the buyer, have to pay me, your agent, a commission of 2.5% or 3%. What that buyer agent is doing is educating that buyer that, hey, look, when we submit your offer, we still do have the ability, when we submit that offer, to request of the seller to agree to pay the buyer agent commission that is identified in the buyer broker agreement. So it's, on the one hand, buyer says, all right, I'm going to hire you to find me a home. Gulp, I'm going to pay you 2.5%. But I'm going to trust you when you submit the offer on my behalf, that you can negotiate to get the seller to agree to pay that commission that I had just agreed to pay you. And I'm seeing that play out, frankly, exactly that way.
Interesting.
And it's kind of what I expected. So in reality, I think we're getting back to normalizing to where things were before, but just with that added step that I think turned out was necessary. Buyer agents need to fully explain to the buyer how they get paid, negotiate with that buyer how much they want to get paid, but then go ahead and go back to what has been a customary practice, ask the seller to pay it. Now, one important caveat about that is when you submit that offer to the seller or to the listing agent, you're not supposed to ask that seller to pay the buyer agent commission in an amount that's higher than what's on your buyer broker agreement. Because there was some abuse of that early on, where maybe you had the buyer sign a buyer broker agreement where you're getting them to agree to pay you, the buyer agent, 2%. But then when you submit the offer to the seller, you're asking the seller, hey, pay the buyer's agent commission at 3%. You can't do that. They have to match. And initially, early on, the first couple of months, you had to submit your buyer broker agreement with your offer so the seller could see what you negotiated with your buyer. Now, more recently, CAR got rid of that. They decided, we don't want sellers to start reviewing a legal contract between the buyer and their agent. So now the standard, what we call RPA, residential purchase agreement, the verbiage has changed to where the buyer and their agent are representing that the concession they're asking from the seller to pay the buyer's agent commission matches what that commission is as reflected in the buyer broker agreement, but you don't have to provide a copy.
Gotcha.
Basically, we represent that they match, and the seller has to take that as valid and then negotiate their deal.
Gotcha. Well, this next one is, when this person who wrote this article, he kind of gives them their take. And I just want to share with you, it says, for buyers, if you've been on the sidelines, I think I've heard you say this a few times, now might be the time to start looking more seriously. It says, while prices are still elevated, increased sales suggest that competition might not be quite as fierce. Also, keep in mind that homes above $1 million are moving quickly. So if you're in this market, be ready. And it says for sellers, been waiting the right time. Now seems like a good window to conclude listing your property. And then long term, while it's great to see the market picking up, it says, I think 2025 would be a good period of adjustment. And they're thinking, okay, is it truly a recovery? Going back to your Econ 101, and I just looked at something this morning that I received from this real estate agent that I receive, I've never done business with him, but he sends me something that says, hey, here are the things listing in La Quinta. And out of the 11 listings, 8 of them had price reductions, which to me, it means, okay, maybe that house has been sitting on the market too long. Maybe it's overpriced, priced incorrectly at the beginning. But doesn't that, as the label said, is this a perfect storm where the inventories have grown? They're not back to pre-pandemic, but because there's fewer buyers, as you said, actually pulling the trigger. If I get a listing, or excuse me, if I get an offer on my home and it's below listing, and that's the only one I've gotten in 45 days, am I now more encouraged to take advantage of that?
Well, exactly. I mean, what's interesting is you're right. I mean, the inventory's grown, not back to normal. We are seeing more price reductions. Many of the agents I've been talking to are frustrated with their sellers because their sellers, I think, have sort of consumed the news about how home prices keep going up, and they often start off instructing their listing agent, to list higher than what the listing agent wants them to list for. That's happening quite a bit, and so as a consequence, even though inventory has grown, there are more buyers. Which on the one hand, you would say, okay, there's more buyers. Maybe as a seller, I can get my initial top dollar asking price, but yet you do have a little more competition now as a seller. So that kind of works against you. And so I think as a consequence, you're starting to see more of these sellers go ahead and ultimately have to reluctantly agree to lower their price a little bit. But and then at the same time, buyers, I think, because their buyer's agent are telling them, hey, look, there's more, like you just described, Jeff. We're seeing more price reductions on the listing inventory. There's your opportunity to negotiate a better price. Give you a real life example. I just did this week. Had an agent call me, wanted me to pre-qualify a buyer on a listing in Cathedral City. Here locally. It was originally listed at $599. It's been on the market for a couple months. They recently lowered the list price to $574. The agent told me, we're going to offer $550. And I said, well, okay, I'll pre-qualify them at $550. Can I give you another option? Can I give you some advice? Sure. What do you have to say? I think you should offer $574. Ask for still get your concession, your $24,000 concession. Ask for it in a seller credit. Get the dollars. And he said, well, why would I do that? Well, I said, well, look, you're going at $550. You're going to help that buyer somewhat in terms of what their monthly payment will be versus the full list price because of the lower loan amount. But if you ask for those dollars, I can do 2 things with that on the loan side. I can use that to cover all their closing costs, and I can use the rest of it to fund a 2-1 buy down. Now his buyer was going with an FHA loan with 3.5% down payment. He loved the idea. He has submitted the offer on that basis. Full list price $574. $24,000 seller credits being requested. We can get this buyer a FHA loan at a 5.99 note rate. 2-1 buy down means first year's at 3.99. All of his closing costs are covered in that $24,000. So he's going to be able to acquire that home with a total out of pocket of $20,000 and have a first year principal and interest payment that will be $550 a month less than if he offered 550,000 with no seller credit.
Wow.
It is an absolute no-brainer. And of course, once I explained it to him and his buyer, they loved it. The buyer loved it. And so I'm just waiting for word that the offer is accepted, and we'll get that escrow open. So that's the kind of scenario. Again, I just did this in the last 2 days that plays right into these factors, these conditions that we're seeing now.
Well, I'm just curious now. I think, stop me if I'm wrong, but I think the average real estate agent would give you some pushback on this because they didn't really understand the process, because they were selling a bunch of homes. Now the number of home sales, even though we saw it increase, we know it's slower. Do you think now they're more receptive to this idea?
Well, I think so. In fact, another story. I got an email from an agent yesterday who I know very well. In fact, she's on my membership committee with the Palm Springs Realtors. And she sent me an email where she had received some sort of solicitation from another, mortgage originator like me. And it referenced what I just described, a temporary buy down. And she forwards it to me and says, "Hey, Art, does this look like a good idea? My seller has been offering to cover HOA dues for the buyer for 12 months as an incentive to get his home sold rather than lowering the price." So after she put that in her email, she said, "But this looks like it might be a better idea. What do you think?" Of course, I replied right back to her and said, heck yes. And of course, I pointed out to her, I'd be happy to give her the numbers, because she doesn't know this originator from Adam. It's somebody from out of the area, actually. So she knows me. She's going to be more comfortable with what I tell her. In fact, Jeff, you'll be happy to know, I sent her one of our previous videos about temporary buy downs that we had designed specifically for sellers.
Oh.
To explain to sellers why offering that is a better option than just lowering your price. So that just happened yesterday. So wow. I think it's an example of an agent who's been around for a long time is now starting to realize, oh yeah, I think I'm starting to get this. I think this might be a better idea.
Yeah, I love that. Well, it's exciting to hear that, and hopefully that helps kind of break that logjam, and the buyers really are starting to see that, hey, this could be that perfect storm. Don't wait till the land is covered by water before you get out there. And as you mentioned earlier, things to consider: get your insurance dialed in, because it's not as a given like it was in the days gone by. I do want to talk about one other thing, Art, before I let you go, and then I'll let you get back to your conference, and that's the VA. And it's really interesting because, first of all, what about VA loans? Who is eligible, and what are the benefits?
Well, the VA home loan program, the VA home loan benefit's been around for a long, long time. Basically, what it provides is someone who is a veteran, either active duty or retired. They have the ability, if they meet certain criteria in terms of how long they were in service, and then, by the way, it doesn't have to mean combat service. And by the way, it also includes National Guard, for example, or reserves. If you meet certain criteria in terms of service, you are going to be eligible for getting financing to buy a home with zero down payment. And one of the major benefits, so that's the major benefit. The other major benefit is interest rates on these loans are usually substantially better than conventional loans. Qualifying for these loans is much more flexible. Debt ratio allowances are much higher. The VA underwriting criteria is a lot more borrower friendly than a conforming conventional loan. But what's interesting about VA loans is the fact that they are underutilized. And it's one of those things where here's this benefit that's out there that not enough eligible borrowers are taking advantage of. And so I've been trying to talk that up for quite a bit lately, because of the fact there are cases where the VA loan would be the perfect solution for a borrower trying to get qualified, and yet they don't really know it's there and take advantage of it.
Well, here's something that just blew me away, and it's this. Just 13% of American vets have ever touched their VA loan. And these are the people who have eligibility. What other things are, just like, as you say, you've been talking up quite a bit. What are the things, if I were a VA listening, if I were a veteran listening out there that's eligible for this, why would I not be aware of this, and how can I take advantage of it?
Well, yeah, and you're right. Is that a remarkable number or what? Only 13% of eligible veterans are using the program. I've heard that a full 1/3 of eligible veterans don't even know they have the benefit to use.
Wow.
I mean, that's almost criminal. And I think it points to a lack of education and, us in the industry making those eligible veterans aware of the benefit. They simply just do not know. So I think when they come out of the service, or if they've been out of the service for a long time, I think the industry has not done a good enough job to make them aware. Now, in addition to that, those who are aware, I think oftentimes are discouraged from using it because there's some misconceptions. There's some misconceptions like, oh, it's too complicated. Oh, it's a government program. It's too slow. I need a 30-day escrow, and you can't get a VA loan in 30 days. And by the way, as to it being a government loan, what that means is, the Department of Veteran Affairs guarantees the loan on behalf of the borrower to the lender. So if the borrower defaults, which is more likely to happen when you put zero down, just the default rate's going to be higher, the lender can get reimbursed for their loss by the VA because of the fact that the VA guarantees the loan. And that's paid for through a fee called a VA funding fee. But the point of it is, I think some veteran borrowers are discouraged from going after it because it's too complicated, it's too slow, and another concern is the VA appraisal, that could complicate things because the VA appraisal is going to be more demanding in terms of the condition of the home being as good as possible, and that there's more likely to be repair requirements that are going to come out of the VA appraisal process. And then the other thing is, the belief that, well, you do have some down payment money. Let's say you've got 10 or 15 or maybe even 20% down. Well, VA loans are for if you don't have down payment. I have a down payment, so I'm better off going with a conventional loan. That is the wrong thinking, because I can show most any prospective borrower, if they're a veteran and they're eligible, even if you're going to put 10 or 15 or 20% down, even 20 where you don't have PMI on your conventional loan, a VA loan is probably, in terms of just bottom line dollars and cents and monthly payment, is still going to be a better option because the rate's so much better.
Wow.
And so they just don't become aware of those kinds of benefits. And I think it's really kind of shameful.
I'm just curious, Art, do you think this is something that, if someone goes into the military, how long do they have to serve before they're eligible for the VA benefit?
Well, in certain circumstances, as little as 90 days.
No way. Okay. All right.
So, and by the way, for anybody who's watching, I'm happy to contact me, and I can send you in all the details in writing as to what the eligibility criteria is, whether you're in the service now or you were and you're out of the service. I'll send that to you so you know exactly what the criteria is. And it's not nearly as significant and challenging as you might think. And by the way, too, if you have any kind of service-connected disability, to the extent, depending on the extent of it, because there's percentages of disability that's established by the VA, you could be exempt from the VA funding fee. So that saves you money on that part of the program, not to mention the fact the interest rate's already going to be a lot better than a conventional loan. And then one other thing I want to point out real quick, the other thing about a VA loan is if you're in a jumbo loan category, you in Riverside County, this varies by county. Riverside County, you can get a VA loan with no down payment for up to $806,500. Well, what if you're buying a home for $2 million, and you're a veteran, Vietnam veteran, and you want to buy a home for $2 million? For jumbo loans, you pretty much have to come up with 20% down or more to get any kind of decent terms. But let's say you're tight on that. What if you looked and saw you were VA eligible? Well, on a $2 million house, what we do is we take the difference between the purchase price, $2 million, the 806,500 that's available with no down payment, take that difference divided by 4, that's your down payment. So instead of having to come up with 400,000 for 20% down, you can come up with just under 300,000, 298,000 to be exact, and you can get the loan.
Wow.
And you're going to get the loan probably at least 0.5%, if not more, lower than a conventional jumbo. There's no PMI, and you're getting a $2 million home with a 15% down payment.
Wow.
So VA loans on the jumbo category is truly the most underutilized product out there.
Do you think this is and again, I'm asking you to speculate now, do you think this is something that, as let's say I were going in to the military, that this is never discussed, and then when I'm exiting the military, this is not discussed, or it is, but it's not something that catches my attention, like, wow, I've got this. And the reason I ask is because when I was a kid growing up, it seemed like I heard that, well, I used my VA loan to buy the house. I heard it more often. I never hear it today.
I think it might be a little bit of a generational thing. The VA home loan benefit, I think, really there was more of a focus on it. I think it was a higher level of awareness, like, say, coming out of World War I, World War II, World War II in particular, because, that was really that period of time where, new construction, new housing really just exploded. That kind of was where we came up with that whole concept of tract housing. And the VA home loan benefit, I think, for those developers back in the 50s, late 40s, 50s, they grabbed onto that benefit as again, it goes back to what we say about home builders. They're very savvy to what finance programs, what loan programs will help us sell more homes. So I think coming out of World War II, and that whole evolution of home building into these tract homes, those home builders were savvy enough to say, hey, wait a minute, veterans, you were just in World War II, you just came out of the military, 3, 4, 5, even 10 years ago. Here's a tremendous benefit that'll help you buy our home for $18,500 with no down payment. Wow. I think there's just less focus on that for the current generation coming out of the military.
I'm just curious also, if a person uses their VA loan, and let's say then they sell their house and they pay the loan off, is that it? They're one and done?
No, that's another misconception. Yeah, when you get the loan, you've used up your entitlement in most cases. Sometimes you get a loan amount that's not the maximum, and so you end up using your partial entitlement. You still have some partial entitlement left. But let's say you've used the full entitlement. If you subsequently sell that home and the loan's paid off, it's not assumed by the next buyer, it's paid off, you can get a reinstatement of your eligibility and use the entitlement for another 0 down payment loan. So that's the other misconception or lack of awareness, that it is a benefit that is reusable multiple times, again, as long as you sold the previous home and paid off the loan. You're good to go. You can get that benefit again and buy another home with no down payment, or if it's a jumbo, a smaller down payment than a conventional loan would require.
Wow. Well, if you're in that 87% of Americans that are vets that they're not even aware of your benefits, and you've served as little as 90 days, as Art said, give them a call, find out where you're at, and wow, what a difference it could make in your ability to buy a home with coming out with very little money down or no money down. And it seems like a no-brainer. And then also the real estate agents out there who are saying, boy, I'm having a hard time selling homes. Maybe combine, I don't know, you tell me, can you combine the VA loan and a 3-2-1 buy down?
3-2-1 is tough to do because a VA loan, by nature of the fact that they allow a 0 down payment, seller concession amount is limited to 4% of the purchase price, not 6% like FHA, or 6% for conventional with 10% down. So with a VA loan, where it works well is get that 4% concession from the seller and then use that to fund a 2-1 buy down, and then use the rest to cover your closing costs, because you could potentially achieve what we used to call a VA no down payment, no closing costs. Because you can make an offer, get a 4% concession, fund that 2-1 buy down where you'll get a similar like 5.99 note rate, 3.99 first year, get all your closing costs covered. So you've got a great combination, a VA no-no and a 3.99% first year rate. I mean, that's the greatest thing since sliced bread, as they say, right? I mean,
if I were a veteran, I'd be moving every 2.5 years.
Oh yeah, exactly.
Well, Art, thank you very much. I appreciate it, especially you ducking out of your conference. I know you're very much involved in it. I really appreciate it. I know we had a lot of folks online today. If you have any questions, let's make sure to get a hold of Art. I'm going to put his information up here next, and so you can see his number, 760-969-5023. That's his office, or the fact that he's out of the office, call him on his cell, 760-612-9035. Art, any last thoughts before we take off today and let you get back to a business there at the convention?
No, I don't think so, other than the fact that, hey, look, if you're a prospective home buyer, you're starting to get out there, kick the tires around, please get me in touch with me so I can tell you about these really good opportunities, again, on the issue of temporary buy downs or permanent rate buy downs, by the way. And as we just covered, if you're a veteran and you've not even considered a VA loan before, or even aware of what the entitlement gets you, get in touch with me. I'd love to have a conversation, give you that information, and use that to help you get home ownership sooner than later.
Thank you, Art. We'll see you next week.
All right. Thanks, Jeff.